Question 1. Foundations of captive insurance. Which of the following is a key advantage of utilizing a captive insurance company for a large corporation? A. Increased access to the reinsurance market without capital investment. B. Ability to capture underwriting profits and have greater control over risk management. C. Immediate tax exemptions on premiums collected. D. Reduced regulatory oversight and fewer compliance requirements compared to traditional insurers. Answer: B. Ability to capture underwriting profits and have greater control over risk management. Explanation: Captive insurance companies provide their parent organizations with significant control over risk management and underwriting decisions. A captive allows the parent to retain underwriting profits that would otherwise be paid to traditional insurance companies. This model also provides more flexibility in managing risks and custom tailoring coverage. While it is true that captives can sometimes access reinsurance markets, they do so under the context of their own financial strength and with specific capital investment, not without it. Furthermore, tax benefits for captives exist, but immediate exemptions on premiums are not one of the core advantages. Captives are also heavily regulated, so they do not experience reduced oversight as stated in option D. Question 2. Scenario-based question on governance and compliance. Mr. Thompson, the CEO of a captive insurance company domiciled in South Carolina, is concerned that one of his subsidiaries has failed to meet its annual reporting requirements to the South Carolina Department of Insurance (SCDI). He is unsure whether the failure to report will lead to any legal consequences or penalties. What should Mr. Thompson do to resolve this issue? A. Mr. Thompson should ignore the issue as there is no penalty for missing the reporting deadline. B. Mr. Thompson should immediately contact SCDI, submit the overdue report, and explain the reason for the delay to avoid penalties. C. Mr. Thompson should wait for SCDI to issue a penalty notice and respond accordingly. D. Mr. Thompson should submit a formal request for an extension from SCDI and provide a detailed explanation for the delay. Answer: B. Mr. Thompson should immediately contact SCDI, submit the overdue report, and explain the reason for the delay to avoid penalties. Explanation: Under South Carolina law, captive insurance companies are required to submit annual reports to the South Carolina Department of Insurance. If a report is not submitted on time, penalties can be assessed. It is critical for Mr. Thompson to take immediate action to remedy the situation by submitting the overdue report and communicating with SCDI to explain any delays. The regulatory body generally prefers proactive communication and the correction of issues as soon as they are identified. Ignoring the issue or waiting for a penalty notice as suggested in options A and C will only exacerbate the situation and may result in severe consequences, including fines or administrative actions. Requesting an extension, option D, is possible, but it does not eliminate the responsibility of submitting reports on time. Question 3. Financial management of captive insurance companies. Which of the following is a common method for calculating premiums for a captive insurance company? A. Premiums are always calculated based on the market rate of commercial insurance providers. B. Premiums are based on the individual risk profile of the insured entity using actuarial data to determine appropriate coverage and pricing. C. Premiums are calculated based on a fixed predetermined rate regardless of the risk profile. D. Premiums are discounted significantly in the first 3 years of operation to attract clients. Answer: B. Premiums are based on the individual risk profile of the insured entity using actuarial data to determine appropriate coverage and pricing. Explanation: One of the main advantages of captive insurance is the ability to tailor premiums to the specific risks faced by the parent company. Premiums are generally calculated based on the risk profile of the insured entity, which involves using actuarial data, historical loss experience, and other relevant factors. Captive managers work with actuaries to calculate an appropriate level of reserves and premium amounts that reflect the actual risks being retained. This approach allows for more customized coverage compared to traditional insurers, who might use market-driven pricing models. Option is incorrect because while commercial insurers may influence captive pricing, captives typically calculate premiums based on their own internal risk assessments. Option C is incorrect because premiums in captives are not fixed, they depend on the specific risks involved. Option D is incorrect because premium discounts in the early years of operation are not typical for captives, which prioritize adequate capitalization and long-term sustainability. Question 4. Risk management principles. Which of the following is a key aspect of enterprise risk management in captive insurance companies? A. Only focusing on insurance-related risks and ignoring non-insurance risks such as operational or strategic risks. B. Integrating risk management into the organization's overall decision-making process, covering all types of risks. C. Relying solely on external consultants to manage and identify risks. D. Setting up separate risk management frameworks for each individual subsidiary of the organization. Answer: B. Integrating risk management into the organization's overall decision-making process, covering all types of risks. Explanation: Enterprise risk management is a holistic approach to risk management that integrates risk identification, assessment, and mitigation into the overall strategy of the organization. Captive insurers use RM to address not just insurance-related risks, such as underwriting and claims risks, but also operational, financial, and strategic risks. This approach is essential for ensuring long-term success and sustainability of both the captive insurance company and the parent organization. Option is incorrect because the RM aims to cover all types of risks, not just insurance-related risks. Option C is not entirely correct because while external consultants can play a role, effective risk management requires internal integration and leadership. Option D suggests a siloed approach, whereas the RM requires a unified organization-wide strategy. Question 5. Taxation and legal considerations. Which of the following is a major tax-related consideration for a captive insurance company in South Carolina? A. Captive insurance premiums are always exempt from state income tax in South Carolina. B. Premiums paid to a South Carolina captive insurance company may qualify for tax deductions as business expenses, subject to IRS guidelines. C. Captive insurance companies are completely exempt from federal taxes regardless of their size or operations. D. South Carolina imposes an additional tax on premiums paid to captives operating within the state. Answer: B. Premiums paid to a South Carolina captive insurance company may qualify for tax deductions as business expenses, subject to IRS guidelines. Explanation: In South Carolina, premiums paid to a captive insurance company may be deductible as a business expense provided that the structure of the captive complies with IRS guidelines for legitimate insurance arrangements. This allows businesses to effectively manage their risk financing while benefiting from tax deductions. However, the IRS has specific rules to ensure that captives are operating as legitimate insurers and not as vehicles for tax avoidance. Option is incorrect because premiums are not automatically exempt from state income tax. A tax treatment is based on compliance with applicable regulations. Option C is incorrect because captives are subject to federal taxes, including those related to underwriting income and other sources of revenue. Option D is also incorrect, as South Carolina does not impose an additional tax on premiums. However, it does regulate captive insurance companies to ensure they meet certain requirements. Question 6. Formation and structure of captive insurance companies. Which of the following is a key requirement for the formation of a captive insurance company in South Carolina? A. The captive must be a branch of an existing commercial insurance company licensed in another state. B. The captive must conduct a feasibility study to assess the viability of the insurance program and risks involved. C. The captive can operate without any initial capital requirements if the parent company provides sufficient financial guarantees. D. The captive is required to establish a physical office in South Carolina even if its operations are primarily online. Answer: B. The captive must conduct a feasibility study to assess the viability of the insurance program and risks involved. Explanation: A feasibility study is a key component in the formation of a captive insurance company. This study helps determine whether the captive is financially viable, whether it can adequately cover the risks of the parent company, and whether the proposed structure and capitalization are appropriate. This process is critical to ensuring that the captive will be able to meet regulatory requirements and effectively manage risk. Option is incorrect because a captive does not need to be a branch of an existing commercial insurer. It can be an independent entity. Option C is incorrect because there are capital requirements to form a captive insurance company. While financial guarantees may be involved, the company must still meet the required capitalization thresholds. Option D is incorrect because captives are not required to have a physical office in South Carolina if they meet other regulatory requirements, that they must comply with the state statutory and regulatory framework. Question 7. Underwriting and claims management. Which of the following best describes a key practice in underwriting for a captive insurance company? A. Underwriting decisions are solely based on commercial market trends with no internal risk assessments. B. Underwriting should be based on the unique risk profile of the parent company and the specific needs of the insured entity. C. Captive insurance companies underwrite the same risks as traditional insurers with no custom modifications to coverage. De-underwriting is generally not required for captives as they operate on a pool basis and share risks with other insurers. Answer: B. Underwriting should be based on the unique risk profile of the parent company and the specific needs of the insured entity. Explanation: in captive insurance, underwriting is tailored specifically to the needs and risk profile of the parent company. Unlike traditional insurers, which must account for broad market conditions and risk pools, captives can customize their policies to reflect the precise risks faced by the parent entity. This custom approach enables captives to offer more efficient coverage based on detailed risk assessments and historical data. Option is incorrect because captives use internal risk assessments rather than relying solely on commercial market trends. Option C is incorrect because captives often modify coverage to meet the specific needs of their parent company, which can be very different from the standardized products offered by traditional insurers. Option D is incorrect because underwriting is essential for captives to assess and price the risks they are assuming. Question 8. Financial management of captive insurance companies. What is the most common method used to manage and transfer risk in a captive insurance company? A. Risk pooling with other captives to diversify risk across multiple entities. B. Relying exclusively on excess coverage from a third-party commercial insurer. C. Retaining risk within the parent company without any external involvement. D. Purchasing reinsurance to reduce the financial impact of high-severity losses. Answer: D. Purchasing reinsurance to reduce the financial impact of high-severity losses. Explanation: reinsurance is commonly used by captive insurance companies to transfer some of the risks they assume, particularly the risk associated with high-severity losses. This helps limit the financial impact of large claims that could otherwise threaten the solvency of the captive. While captives may engage in risk pooling with other entities or rely on third-party insurers for excess coverage, reinsurance remains a critical tool for managing the overall risk exposure and ensuring financial stability. Option A is incorrect because while risk pooling can be a useful strategy, it is not the most common or primary method of risk transfer. Option B is incorrect because third-party coverage may complement captive operations but does not replace the need for reinsurance. Option C is incorrect because fully retaining risk without external mitigation could expose the parent company to unsustainable losses. Question 9. South Carolina-specific captive market. Which of the following is a unique feature of South Carolina's captive insurance market? A. South Carolina offers no special tax incentives for captives compared to other domiciles. B. South Carolina is one of the few states with no minimum capital requirements for captive formation. C. South Carolina provides flexibility in terms of the types of captive insurance companies allowed, including pure captives, group captives, and risk retention groups. D. South Carolina restricts the types of coverage that captives can offer, limiting them to property and casualty insurance only. Answer: C. South Carolina provides flexibility in terms of the types of captive insurance companies allowed, including pure captives, group captives, and risk retention groups. Explanation: South Carolina is known for its flexible regulatory environment for captives, allowing various types of captive structures, including pure captives, which insure the risks of their parent, group captives, which pool risks from multiple unrelated entities, and risk retention GRGS that can provide liability insurance for their members. This flexibility is a major draw for companies looking to form captives in South Carolina. Option is incorrect because South Carolina does offer competitive tax advantages for captives, including tax deductions for premiums paid to South Carolina-based captives. Option B is incorrect because South Carolina does have minimum capital requirements for forming captives, though these are generally considered reasonable. Option D is incorrect because South Carolina allows captives to provide a broad range of coverages, including property liability, workers' compensation, and specialty lines like cyber insurance. Question 10. Captive ownership structure. Which of the following is a common ownership structure for a captive insurance company? A. The captive must be owned exclusively by the insured entity with no third-party ownership allowed. B. The captive may be owned by a group of unrelated businesses to pool risks, known as a group captive. C. A captive can only be owned by a traditional insurance company. D. Captives are typically owned by foreign entities and are not subject to U.S. regulations. Answer: B. The captive may be owned by a group of unrelated businesses to pool risks, known as a group captive. Explanation: a group captive allows multiple unrelated businesses to pool their risks and create a captive insurance company together. This structure helps diversify risk among members, reduce costs, and provide customized coverage. Option A is incorrect because while single-parent captives are common, group ownership is also a widely used structure. Option C is incorrect because captives are typically owned by the parent business or group, not by traditional insurers. Option D is incorrect because U.S. domiciled captives are subject to U.S. regulations and foreign ownership does not exempt them from compliance. Question 11. Captive formation process. Which of the following steps is typically involved in the formation of a captive insurance company? A. The captive must first obtain approval from the Federal Reserve before proceeding. B. A feasibility study must be conducted to determine the financial viability and risk management strategies. C. The captive must be formed in a country that does not have any insurance regulations. D. The captive must be structured as a subsidiary of a publicly traded company. Answer. B. A feasibility study must be conducted to determine the financial viability and risk management strategies. Explanation. A feasibility study is a critical part of forming a captive insurance company. This study evaluates the financial stability, risk management needs, and overall feasibility of the captive. It ensures that the captive will be able to provide sufficient coverage for its parent company and meet all regulatory requirements. Option is incorrect because the Federal Reserve is not involved in the formation of a captive. Option C is incorrect as most captives are formed in regulated environments, including U.S. states like South Carolina. Option D is incorrect because while a captive can be a subsidiary of a parent company, it does not need to be publicly traded. Question 12. Captive insurance premiums. Which of the following is true regarding premium payments for captive insurance companies in South Carolina? A. Premiums paid to captives in South Carolina are subject to a state sales tax. B. Premiums paid to a South Carolina-based captive insurance company may be deductible as a business expense for the parent company. C. Premiums are generally not deductible under South Carolina state law. D. Premiums paid to captives are always taxed at the federal level, regardless of the size of the captive. Answer. B. Premiums paid to a South Carolina-based captive insurance company may be deductible as a business expense for the parent company. Explanation. In South Carolina, premiums paid to a South Carolina-based captive insurance company are generally deductible as a business expense, subject to IRS guidelines. This allows companies to manage their risk financing efficiently while benefiting from tax deductions. Option A is incorrect because there is no state sales tax on insurance premiums in South Carolina. Option C is incorrect because premiums paid to captives may be deductible if they meet the necessary IRS requirements. Option D is incorrect because while premiums are subject to federal tax rules, they may not always be taxed at the federal level depending on the structure and compliance of the captive. Question 13. Regulatory oversight of captive insurance. Which entity is responsible for regulating captive insurance companies in South Carolina? A. The U.S. Securities and Exchange Commission (SEC). B. The South Carolina Department of Insurance. C. The Federal Insurance Regulatory Agency (FINRA). D. The South Carolina General Assembly. Answer. B. The South Carolina Department of Insurance. Explanation. The South Carolina Department of Insurance is responsible for regulating captive insurance companies within the state. This department ensures that captives comply with state laws, meet financial requirements, and operate transparently. Option is incorrect because the SEC oversees securities regulations, not insurance. Option C is incorrect because there is no federal regulatory body specifically for captive insurance. It is primarily managed at the state level. Option D is incorrect because the South Carolina General Assembly creates laws, but the Department of Insurance enforces them for insurance companies. Question 14. Captive insurance tax incentives. What is one of the tax advantages for forming a captive insurance company in South Carolina? A. Premiums paid to a South Carolina captive are completely exempt from federal income tax. B. South Carolina offers a low effective tax rate on underwriting profits for captives. C. Captives in South Carolina do not have to pay state taxes on investment income. D. South Carolina guarantees that captives will be exempt from both federal and state income taxes. Answer. B. South Carolina offers a low effective tax rate on underwriting profits for captives. Explanation. South Carolina offers a competitive tax environment for captives, including a low effective tax rate on underwriting profits. This helps make South Carolina an attractive domicile for captive insurance companies. Option A is incorrect because premiums are not exempt from federal taxes. Option C is incorrect because captives in South Carolina are still subject to state taxes on investment income. Option D is incorrect as tax exemptions are not guaranteed at both federal and state levels. Question 15. Reinsurance in captive insurance. What is the primary purpose of reinsurance for a captive insurance company? A. To increase the premium revenue of the captive by offering coverage to other insurance companies. B. To reduce the financial burden on the parent company by transferring part of the risk to a third-party insurer. C. To avoid paying any claims by shifting responsibility to other insurers. D. To guarantee that the captive will never experience a loss. Answer: B. To reduce the financial burden on the parent company by transferring part of the risk to a third-party insurer. Explanation: Reinsurance is used by captive insurance companies to manage their risk exposure by transferring part of the financial burden to a third-party insurer. This is especially important for high-severity or high-frequency losses. Option A is incorrect because reinsurance does not directly increase premium revenue. It is a risk management tool. Option C is incorrect because reinsurance does not absolve the captive of its obligations. It simply shares the risk. Option D is incorrect because reinsurance does not eliminate all risk, it reduces it. Question 16. South Carolina captive insurance market. Which type of captive insurance company is most likely to benefit from the regulatory environment in South Carolina? A. A large multinational company with diverse international operations. B. A small business looking for a low-cost option to insure its operations. C. A company with high-risk, unpredictable operations that requires highly specialized coverage. D. A company that is part of a larger conglomerate with no previous risk management strategy. Answer: C. A company with high-risk, unpredictable operations that requires highly specialized coverage. Explanation: South Carolina's captive insurance regulations are particularly beneficial for companies with unique or high-risk operations that require highly specialized insurance solutions. Captives allow these companies to tailor their coverage precisely to their needs. Option is incorrect because while captives can benefit multinational companies, they are often more cost-effective for smaller businesses or those with specialized needs. Option B is incorrect because while captives can be a cost-effective solution, they are more appropriate for companies with complex or high-risk exposures. Option D is incorrect because captives require a developed risk management strategy, which may not be suitable for a company with no prior risk management experience. Question 17. Captive insurance and risk management. Which of the following is a key benefit of using a captive insurance company for risk management? A. The parent company has more control over claims management and underwriting decisions. B. Captives automatically provide broader coverage than traditional insurers at a low cost. C. Captives guarantee that the parent company will receive a return on investment. D. Captives do not require any regulatory oversight or financial reporting. Answer A. The parent company has more control over claims management and underwriting decisions. Explanation: A primary benefit of a captive insurance company is that it provides the parent company with more control over both claims management and underwriting decisions. This control allows for more customized coverage and a proactive approach to risk management. Option B is incorrect because captives do not automatically provide broader coverage or lower costs. These factors depend on the captive's design and risk profile. Option C is incorrect because while captives can be profitable, they do not guarantee a return on investment. Option D is incorrect because captives are subject to regulatory oversight and must meet certain financial reporting requirements. Question 18. Captive insurance risk retention. Which of the following describes a risk retention group (RAG) in the context of captive insurance? A. A risk retention group is a type of group captive where members are related and share risks with other insurers. B. A risk retention group allows members to pool and insure their liability risks while retaining control over the coverage. C. Risk retention groups can only provide coverage to individuals, not businesses. D. A risk retention group is a special type of commercial insurer that is unrelated to captives. Answer: B. A risk retention group allows members to pool and insure their liability risks while retaining control over the coverage. Explanation: A risk retention group (RIG) is a type of group captive where members, typically from similar industries or businesses, pool their liability risks and share in the underwriting, claims, and other management functions. This structure provides more control over coverage and helps businesses manage liability risks more effectively. Option is incorrect because RIGs are formed by members with common risks, but they are not typically related in the same way as other types of captives. Option C is incorrect because IGS are specifically designed for businesses, not individuals. Option D is incorrect because a risk retention group is a form of captive, not a traditional commercial insurer. Question 19. Captive insurance and self-insurance. Which of the following best describes the relationship between captive insurance and self-insurance? A. Captive insurance is always a form of self-insurance. B. A captive insurance company is a legally separate entity, while self-insurance involves directly setting aside funds for potential losses. C. Self-insurance and captives have no common elements. D. Captive insurance eliminates the need for self-insurance altogether. Answer: B. A captive insurance company is a legally separate entity, while self-insurance involves directly setting aside funds for potential losses. Explanation: Captive insurance and self-insurance are related in that both involve assuming financial responsibility for certain types of risks. However, a captive insurance company is a legally distinct entity that operates under specific regulations, while self-insurance involves the company setting aside funds internally to cover potential losses without establishing a separate legal entity. Option A is incorrect because a captive insurance company is not always a form of self-insurance. It involves more structured risk management and regulatory oversight. Option C is incorrect because self-insurance and captives share similarities, particularly in how they manage risk. Option D is incorrect because captives do not completely eliminate the need for self-insurance. Rather, they may be used in conjunction with it. Question 20. Captive insurance and loss reserves. How do captives manage loss reserves, and why is it important? Loss reserves are set aside to cover future claim payments and ensure that the captive has sufficient funds to meet its obligations. B. Captives typically do not need to maintain loss reserves, as they can rely on external insurers to cover claims. C. Loss reserves are only necessary for captives that deal with property and casualty insurance, not other types of insurance. D. Captives can use loss reserves to invest in high-risk ventures that may generate additional profits. Answer: A. Loss reserves are set aside to cover future claim payments and ensure that the captive has sufficient funds to meet its obligations. Explanation: Loss reserves are an essential component of any insurance company, including captives. They represent funds that are set aside to cover future claims based on estimates of potential liabilities. Maintaining adequate reserves ensures that the captive will have the financial resources needed to pay claims when they arise. Option B is incorrect because captives are responsible for their own reserves and cannot rely on external insurers for all claim payments. Option C is incorrect because loss reserves are important for all types of insurance, not just property and casualty insurance. Option D is incorrect because loss reserves must be used to cover liabilities, not for speculative investments. Question 21. Captive insurance and compliance. What is a key compliance requirement for a captive insurance company operating in South Carolina? A. The captive must submit quarterly reports to the U.S. Securities and Exchange Commission (SEC). B. The captive must maintain a minimum level of capital and surplus as required by the South Carolina Department of Insurance. C. The captive is exempt from maintaining any form of capital if it only provides reinsurance coverage. D. Captives are not required to comply with state insurance regulations if they operate outside of the U.S. Answer: B. The captive must maintain a minimum level of capital and surplus as required by the South Carolina Department of Insurance. Explanation: Captive insurance companies in South Carolina are required to maintain a minimum level of capital and surplus as mandated by the South Carolina Department of Insurance. This ensures that the captive has enough financial resources to meet its obligations to policyholders. Option A is incorrect because the SEC does not oversee the regulatory compliance of captives. Option C is incorrect because all captives, including those providing reinsurance, are subject to capital and surplus requirements. Option D is incorrect because captives operating in South Carolina must comply with state regulations regardless of where they are domiciled or whether they operate internationally. Question 22. Captive insurance and risk diversification. Which of the following is a reason why a company might choose to form a captive insurance company? A. To pool its risks with other companies in order to achieve greater risk diversification. B. To eliminate the need for any external insurance coverage entirely. C. To avoid paying premiums to third-party insurers while retaining all insurance risks internally. D. To transfer all risks to external reinsurers without retaining any risk. Answer: A. To pool its risks with other companies in order to achieve greater risk diversification. Explanation: One of the key benefits of forming a captive insurance company is the ability to pool risks with other businesses, particularly in group captives. This diversification helps spread risk and reduce the overall cost of insurance. Option B is incorrect because captives are not designed to completely eliminate external insurance. They are used as part of a broader risk management strategy. Option C is incorrect because captives still need to retain some level of risk and cover it through reserves. Option D is incorrect because captives do not transfer all risks to reinsurers and they retain a portion of the risks. Question 23. Taxation of captive insurance in South Carolina. How are captives taxed in South Carolina? A. Captives are taxed as regular commercial insurance companies under the state's corporate income tax rates. B. Captives are subject to a separate insurance premium tax imposed by South Carolina. C. Captives are exempt from all state taxes in South Carolina. D. Captives are taxed at a higher rate than traditional insurers in South Carolina. Answer: B. Captives are subject to a separate insurance premium tax imposed by South Carolina. Explanation: in South Carolina, captives are subject to a separate insurance premium tax, which is different from the standard corporate income tax. This tax is applied to the premiums written by the captive and is designed to ensure that the state receives revenue from insurance operations. Option is incorrect because captives are taxed under a separate set of rules than traditional insurance companies. Option C is incorrect because captives are not exempt from state taxes. Option D is incorrect because captives are not taxed at a higher rate than traditional insurers, but they are taxed based on their unique insurance activities. Question 24. Captive insurance and regulatory oversight. Which of the following is the primary responsibility of the South Carolina Department of Insurance (SCDI) when it comes to captive insurance companies? A. Ensuring that captive insurers maintain adequate financial reserves and comply with regulatory reporting requirements. B. Overseeing the investment strategies of captive insurance companies to maximize returns. C. Granting tax exemptions to captives that meet certain operational requirements. D. Managing the claims and underwriting process for all captives domiciled in South Carolina. Answer A. Ensuring that captive insurers maintain adequate financial reserves and comply with regulatory reporting requirements. Explanation: the South Carolina Department of Insurance (SCDI) is responsible for overseeing captive insurance companies, ensuring that they comply with all regulatory requirements, including maintaining adequate financial reserves and submitting timely regulatory reports. Option B is incorrect because the SCDI does not manage the investment strategies of captives, although it ensures that captives maintain solvency. Option C is incorrect because while captives may receive certain tax benefits, tax exemptions are not directly granted by the SCDI. Option D is incorrect because the SCDI does not manage claims and underwriting for captives. These responsibilities are handled by the captive itself. Question 25. Capitalization and financial solvency of captives. What is the primary purpose of capitalization requirements for captive insurance companies in South Carolina? A. To guarantee that captives will be able to pay their claims and maintain financial solvency. B. To ensure that captives can pay all regulatory fees and taxes imposed by the state. C. To allow captives to have higher levels of profitability by attracting external investors. D. To enable captives to cover administrative and operational costs without the need for underwriting reserves. Answer A. To guarantee that captives will be able to pay their claims and maintain financial solvency. Explanation: capitalization requirements for captive insurance companies in South Carolina are designed to ensure that captives maintain sufficient financial reserves to meet their future obligations, particularly in the payment of claims. These requirements are a critical part of the regulatory framework ensuring the financial stability of the captive. Option B is incorrect because while captives may need capital for operational costs, the primary purpose of capitalization is solvency, not paying fees or taxes. Option C is incorrect because capitalization is not intended to attract external investors for profitability but to ensure financial strength. Option D is incorrect because capitalization is primarily intended to ensure the solvency of the captive, not to cover operational costs alone. Question 26. Types of coverage in captive insurance. Which of the following is the most common type of coverage provided by captive insurance companies? A. Property and casualty insurance. B. Political risk insurance. C. Life insurance. D. Cyber insurance. Answer A. Property and casualty insurance. Explanation: captive insurance companies typically provide property and casualty insurance, as these types of risks are more commonly retained by captives. These risks include coverage for physical assets, property and liability risks. Casualty. Option B is incorrect because political risk insurance is generally offered by specialized insurers, not by most captives. Option C is incorrect because life insurance is not commonly provided by captives, as the nature of life insurance typically requires a larger capital base and more extensive regulatory oversight. Option D, while growing in importance, is not the most common type of coverage offered by captives compared to traditional property and casualty lines. Question 27. Underwriting in captive insurance. When assessing the risks of a new policyholder, which of the following would be considered an essential step in the underwriting process for a captive insurance company? A. Reviewing the financial stability and loss history of the policyholder to ensure the captive can absorb the risk. B. Calculating the profit margins of the captive insurer's investments. C. Setting the price of the policy based solely on the competitive rates in the market. D. Ensuring that the policyholder adheres to environmental regulations relevant to the business operations. Answer A. Reviewing the financial stability and loss history of the policyholder to ensure the captive can absorb the risk. Explanation: in the underwriting process, a captive insurance company must evaluate the financial stability and loss history of the policyholder to determine if the captive can absorb the potential risks. This step helps ensure that the captive remains financially solvent and able to pay future claims. Option B is incorrect because while investment performance is important, it is not a primary focus in underwriting. Option C is incorrect because the price of the policy should be based on the risk assessment rather than competitive market pricing. Option D is important but is generally part of a broader risk management process, not the primary focus of underwriting. Question 28. Emerging trends in captive insurance. Which emerging trend is becoming increasingly important for captive insurance companies to manage in the current business environment? A. The development of risk models using blockchain and artificial intelligence for improved risk assessment and management. B. The shift to fully automated underwriting without human intervention to reduce operational costs. C. The exclusive reliance on traditional actuarial methods without integrating new technologies. D. The elimination of risk sharing and reinsurance arrangements in favor of total risk retention. Answer A. The development of risk models using blockchain and artificial intelligence for improved risk assessment and management. Explanation: emerging trends in captive insurance include the use of advanced technologies such as blockchain and artificial intelligence (AI) to improve risk assessment and management. These technologies allow for more accurate predictions, greater transparency, and more efficient processes. Option B is incorrect because while automation is becoming more common, it is unlikely that underwriting will become fully automated without human oversight. Option C is incorrect because traditional actuarial methods are being complemented by new technologies for better risk management. Option D is incorrect because risk sharing and reinsurance arrangements continue to play an important role in managing larger risks. Question 29. Taxation of captives in South Carolina. Which of the following tax considerations is most likely to impact a captive insurance company domiciled in South Carolina? A. Captives may benefit from lower tax rates on premiums compared to traditional insurers, encouraging their formation. B. Captives must pay federal income tax at a higher rate than commercial insurance companies. C. Captives are exempt from state income tax but subject to local business taxes. D. Captives must report and pay taxes on global profits, regardless of where the risks are located. Correct answer A. Captives may benefit from lower tax rates on premiums compared to traditional insurers, encouraging their formation. Explanation: South Carolina provides tax incentives for captive insurance companies, including lower tax rates on premiums compared to traditional commercial insurers. This encourages businesses to form captives as a way to manage their risks more efficiently and cost-effectively. Option B is incorrect because captives are generally taxed similarly to other insurers, not at a higher rate. Option C is incorrect because captives are subject to state income tax, but they may benefit from certain tax incentives for premiums. Option D is incorrect because captives are generally taxed on the premiums written in their state of domicile, not on global profits. Question 30. Claims handling and captive insurance. Which of the following best describes the claims handling process for a captive insurance company? A. The captive insurer has full control over claims management, including determining settlements and payments. B. The captive is required to outsource claims management to a third-party administrator for all claims. C. Claims are handled only by the policyholder with no involvement from the captive insurer. D. The captive insurer's role is limited to reporting claims to the South Carolina Department of Insurance with no active claims management. Answer A. The captive insurer has full control over claims management, including determining settlements and payments. Explanation. A key advantage of forming a captive insurance company is the ability to maintain full control over the claims handling process. This includes determining settlements, managing claims, and making payments. This control allows captives to tailor their claims management process to their specific needs. Option B is incorrect because while captives may choose to use third-party administrators, they are not required to outsource all claims management. Option C is incorrect because the captive insurer is actively involved in claims handling, not just the policyholder. Option D is incorrect because while captives must comply with regulatory reporting requirements, they remain actively involved in managing claims.